what you need to know simply is this. Disney, number one, these are not new numbers. They are what's called recast, meaning that this is everything that Disney has reported for the last 12 months and through fiscal year 2022, which ended about a year ago now. They're restructuring how they state them on the financial return. So now ESPN and sports are their own separate division that's been removed from entertainment and television and linear broadcast. So now ESPN, ESPN Plus, and sports on ABC are all in sports, okay? Then you've got the entertainment division, which is now just television and movies. And then you've got parks and experiences. And merchandise licensing is split up between the three of them, depending on where that licensing is housed. Was it a film or television IP? Was it merchandise that was sold with ESPN logos on it? Or was it a model of the Epcot Spaceship Earth that was sold? That's where those licensings, those revenues will be realized. So, there's a lot that changed here, but Mike, go ahead and give
I'll
us
draw an analogy to people because I got this question a lot before I came on the show today. But the analogy is similar to this. Let's just say, for example, you got $1,000 in the wallet in the pocket. Now Disney is saying, well, I got 300 in the front right pocket, 200 on the front left pocket, 400 on the back left, and 100 on the back. It's still the same net. The thing is that this upcoming board meeting, in order to talk about the financials the way they want to talk about them, and I think there's a reason why that I'm going to speculate, and I'd love to get these three gentlemen's response. Mm-hmm. They want to talk about the numbers in a certain way on this upcoming call on November 8th, which, by the way, ladies and gentlemen, stay tuned. It's right around the corner. It's what we call a hop, skip, and a jump around the corner. So they want to talk about this stuff in a certain way. And because we're in the middle of a fiscal year, they can't talk about things in the new way. So that analogy I use where they want to say that we got so much in the front right pocket, so much in the front left, so much in the back left, so much in the back. They can't do that because investors could say, well, what the hell? I don't understand how you're slicing I understand I still have one cake, but I don't understand, I don't understand how you're presenting this to me. And so what they have to do is they had to go back to prior quarters and recast or retell the numbers they already told one way into a different way, but it's still the same numbers. Now, let's jump ahead to why I think they're doing this. I think the reason why is that they've got a certain statement that they want to lay out that's going to strategically align with how they want to close these books out this year in order to get ready for what's going to happen. And let's remember that the first quarter of the fiscal year just started on October 1st. Ladies and gentlemen, when they talk to us on November 8th at that shareholder meeting, that earnings call, I should say, at the earnings call that we're going to get on November 8th, that's reporting on what's happened through September 30th of this year, which, by the way, is the end of their fiscal year because the first fiscal year for Disney runs October 1st through December 1st. For us on a calendar year, that's our January 1st to March 31st. So the first 3 months of the financial year for Disney have actually already started. We are in October 1st to December 31st. We're in the next fiscal year. Now, some people have asked me, well, why the heck do they do that? Well, historically, Disney wanted to do that because they had such a big business. They did it for two reasons. One is that Christmas the holiday season was really big for Disney parks. So they wanted that first quarter of the first fiscal year to boom with a bang. And frankly, because the park going experience, the attractions, the amusement parks and all of that, the summer would wind down and people would kind of wrap up their vacationing by no later than September, guess what? In the olden days, kids went back to school either the first or the second week of September. There wasn't this going back to school in July and August like we've had the last decade. Everybody went back to school usually the second week of September.
What's this Labor Day you speak of, Mike? I've never heard of such a thing.
Oh, it's racist, and we don't need to
patriarchy.
It's patriarchy and racism. So what they did is they said, well, we want to start our fiscal year off with a bang because that first quarter then will have the holiday season results. It'll end in December. We'll have all the Christmas visitors, blah, blah, and we want to end it in September 30th, because that'll be wrapping up a nice little bow. And in the middle, we might have some bad months here and there, but we'll sort of just bury that like books on a shelf with bookends. Anyway, so I think this is it's a long way of getting to the point. The point that I'm making is that if we look at what Disney needs to do or wants to do, they've got to sell some stuff, people. They've got to sell some stuff. We've heard rumors, pros reported on it, VR's reporting about it, yada, 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 yada. And they've got to sell something. Now, there's speculation that they're going to sell ABC and the broadcast. There's some speculation that they're going to take in money and or sell some of the sports contracts. And guess what? The reporting that they're going to do has already shown by them recasting the numbers that sports and the fees related to advertising and sponsorships related to the sports has been incredibly popular. In terms of a percentage of the cost, it's actually more, although the parks generate more cash, the profitability of the actual sports related stuff on the networks is very profitable and lucrative. And for a company that might want to have a higher valuation of those assets, then they're going to want to present that they've not just got one quarter of good numbers, but they've got, look how we just did this quarter. And guess what? That's how we've been doing the other quarter. So I want to sell you, Mr. Coleman International Global Venture Capital Fund, what I got here in the front right pocket, because now that you can see what's in the front right pocket, you're going to give me a good valuation. I pass to Ron or Pro. Go.
Well, let me insert very shortly. I'm talking about very short, and then Ron, I want to hear what your thoughts are. I just want to say that we very likely should have already seen what was going on with Hulu. That should have been made public. The fact that we don't have anything on Hulu yet suggests to me, although it's not certain, I'm not privy to the information here, they may not make the December deadline that they wanted in integrating Hulu into Disney Plus, and that's a big deal. Ron?
Well, actually, I'm glad you brought that out, and I was thinking of this earlier when Valiant was speaking. I had mentioned the Netflix deal. I meant the Hulu deal, of course. Mike, if you could explain where on the balance sheet on this pro forma here that we're looking at on the screen here, the recasting, what are the numbers that reflect that what you've just described, which is the recasting of the value of the of particular assets, including, for example, the sports contracts?
All right, so Valiant's
where I'm circling,
yeah. So I'll go ahead. For example, so what they show here is that by reorganizing in column 2, where it says reorganizing the media and entertainment businesses. So what's happened is they pulled out 13.031 billion out of what was previously thought to be all of the entertainment stuff. And what they've done is saying, look, if we take just the sports related stuff out of what was formerly when it was buried into all of entertainment,
the 42.8 billion right there.
Right. So before we told you that we had $42.8 billion worth of stuff, including linear networks, direct-to-consumer, content sales, licensing, elimination. If we reorganize, we now want to show you that we've got $13.031 billion worth of pure sports.
Out of that 42.
Without the DTC and other crap.
Well, ESPN's DTC, ESPN Plus
I'm sorry,
in
I
that.
meant streaming. Sorry, I just said streaming.
They did remove one element from what was previously all of direct-to-consumer. So direct-to-consumer at Disney was, of course, Disney Plus. It was the 67% of Hulu that Disney owned. And it was also ESPN Plus. So ESPN Plus was removed from DTC, and ESPN and ABC Sports were removed also from the rest of entertainment. And that's where that 13 billion, this is pure sports play, Disney. This is everything. This is $13 billion of revenue that the Walt Disney Company received from its sports business. And that even included merchandise licensing and sales for like ESPN branded paraphernalia or stuff like this. Anything that was connected to sports is now separated out into its own segment. And they did that a few places. So that was one of the big interesting things, because like, as Mike pointed out, if they want to sell ABC, they want to be able to show more clearly, this is what's coming from, the pure entertainment side of linear broadcast, news divisions, television.
But it also enables them in future years to show a less of a year after year decline in the remainder, because they're already socializing us to a lower overall entertainment number, or entertainment not including sports, which would be the
right.
That you're correct. You're 100% on point.
Yep. And they do give us a little bit more depth and resolve in, some of the various breakdowns. And let me scroll down to where they get into some of this in what they call intra-segment revenue. And you can see here, okay, this is the recast quarterly segment results for this fiscal year, the 2023 fiscal year. So that would be the quarter from October 1st to December 31st of last calendar year, 2022. April 3rd and July 1st. So remember, the quarter that ended December 31st, 2022, what were the big film titles, for example, that came out in that quarter? You had Strange World, which didn't do so well. You had Wakanda Forever. You also had Avatar, about a week and a half, or maybe about a week or so of Avatar. I think, 2 weeks of Avatar. It came out on December 16th, embedded in there. And then in the quarter ended April 1st, for example, in the theater, you had the rest of Avatar's run. You also had Quantumania, Ant-Man and the Wasp Quantumania. And I think that was it for that quarter. And then in the July quarter, you had Guardians of the Galaxy. You had Little Mermaid, and you had one day of Indiana Jones and the Who Gives a Flip. So, yeah. So, but you look down there, entertainment, $10 billion or so per quarter, pretty steady. Sports, 4.6, 4.2, 4.3. Parks and experiences, 8.5, 7.6, 8.1. And then they had some eliminations in there. We don't need to go in the weeds too much unless, Mike, you want to comment on that. But then you get down here.
Can you scroll down one more line? Just one line. Right, stop.
Yep. Now, I was going to say, so when we get to the entertainment division, and then everybody pay attention to segment operating income or loss. This is a profitability metric before you pull out things like interest and taxes and sometimes a few other items in there. But you look at the entertainment side, that's sports, you can see the definition there, and then parks and experiences. So what do we always say? Where does Disney make their highest profit margin? Where is their nut made? Parks and experiences, hotels, parks, resorts, timeshares, Disney, what's the Disney timeshare? Disney Vacation Club, DVC, things like that all comes under experiences. But if we go to revenue here, for revenues and operating income, OI for entertainment, Mike, you want to comment on some of this stuff?
Yeah, I mean, basically, okay, hold right there. So if you look at the DTC stuff, I mean, here's some things that are notable. Direct to consumer, 14.85 billion in, 2.076 billion out in the 9 months into July 1st, 2023. That is freaking massively huge, and that ties back to what Ron was saying earlier.
Yep. So
does that include the loss of the Indian business?
Well, Hotstar is still in there. So okay. Hotstar is still part of DTC.
So it's going to get worse.
Yes.
Yep.
So what you're looking at there, Ron, and audience, okay, so on the direct-to-consumer revenues, let's just take the 9 months ended July of 2023, okay? So this is what you could most closely compare to Netflix. So DTC now includes the 67% of Hulu and all of Disney Plus, of course. So $14.8 billion is what they brought in total revenues, but they lost over $2 billion down there direct to consumer and operating losses.
And so going back to the comment I was making earlier when Ron and I were going back and forth earlier, which is that if you look at that revenue, linear networks, 9.073 billion, that's the total. And then they're saying the linear networks had a profitability of 3.3 billion. Well, you do the percentage. Hey, Ron Coleman, global venture capitalist, if you buy this thing from me at a valuation of, 5x at 45 billion, you shouldn't worry, because guess what? For every dollar you're going to bring in, you have a 30% net profit margin, Ron. Wouldn't you want to buy that, Ron?
Right. Look how much more profitable. And that's without sports.
Ron, guess what? Seller financing available, no credit check, and say, habla el español.
Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.